We're live with the commodity report today. So if you guys are checking out the market today, there is a lot of movement. And it's not just I'm sure we're going to talk about equities today too, because there's just so much going on. Kind of got to touch on it. But looking at, the commodities are just on a one-day performance. What's in first place in futures? Well, it's obviously the VIX. VIX up 33% right now. Was up a lot more earlier, and the cash VIX hit 50. So that's a pretty wild move to see in the VIX in one day. Cocoa right behind that, up 4% today, almost 5% at the moment. The yen's up over 2%. Ethanol right behind that, up almost 2%. Rough rice, sugar up 1%. So we're seeing some movement here, which is kind of interesting. So we are seeing some of the softs kind of moving. And they're actually down a lot less than most of the equity markets at the moment, with the NASDAQ down. It's actually down only 2% now. It opened, I think, down 5%, so it was down pretty big this morning. I know the Russell 2000 was down 6%. So a lot of these things got hit pretty quickly, but these are kind of erasing these pretty quickly as well. Me and Kevin were talking off mic a little bit. Just myself, I haven't seen many situations where the VIX hits 50. In a bull market, basically saying like we're in a solid uptrend and the VIX has hit 50. Breadth continues to make new highs. It's kind of interesting, not saying or suggesting like go out there, buy dips and so on. But I am saying that I would think that this might be a little bit more short-lived than people believe. Yes, I'm sure it's painful. I'm sure a lot of people woke up with kind of a rough morning. I'm not saying that that's part of trading. You're gonna look at your account some days, and you're gonna look at, if you have 20 positions on, 18 of those positions are gonna be down and a few are gonna be stopped. It's just how it's gonna be. But when you look at it and you see crude oil bouncing, you see gold's kind of catching a little bounce today after the open. Silver's catching a bounce. I really think that this might be a little bit more short-lived than people think. So Kevin, you look at levels, and so looking at levels here, what are you thinking people should be paying attention to, looking out for, and what should they do going forward?
Yeah. All right. So let's give the backdrop, and I'll get the levels here for you. So the backdrop is we've had a pretty subdued VIX over the last couple of months, right? Some of that's structural, looking at the 0 DTE and 1 DTE options, 0 day to expiration, 1 day to expiration options here. And so that actually took a lot of the momentum out of the VIX itself. Over the last couple of weeks, though, or actually last week, I've been bringing up here that, we have seen institutions starting to go out on duration when it comes to buying puts, meaning that they want to hedge themselves a little bit more for the longer term. And they did not mind at that time to spend the money on the premium for those downside puts. Because of what's happening, not only just in the equity session for the US, but what's also happening overnight. And I think that's really the protection that's been taking place there. And now we see actually a spike in the VIX. And as you kind of talked about, a 50 VIX, very significant for the near term here. But one thing to kind of note, and I'll just try to get you this updated chart here. You're seeing the backwardation between the spot VIX, which measures 30-day vol. And if you look at the front month futures contract, the spread between them right now, I think, is printing at around 30. And actually earlier this morning was a lot higher than that, almost like double that. That's actually the highest spread of a backwardation spread that we've seen on the VIX since 2008, since the crash of 2008. So that's kind of the perspective that you're in here. Now, what does that all mean, right? Is it as bad as 2008? No. If it was, we would actually start seeing that backwardation or that curve actually tightening up, meaning the further in contracts on the VIX kind of moving up, trying to match or even exceed what we would see on the front end or on the spot VIX. So right now, the market is still pricing in near-term volatility, not really looking. Now, don't get me wrong, there's a backwardation of the curve, but it's not as aggressive as we are seeing on spot VIX. So that's kind of the structure that we're in right now. And until we actually start seeing that kind of creep to the downside, keep in mind that we probably will see elevated volatility. But if you look at the VIX on a 20-year, 30-year time frame, right, these spikes usually do not last that long. The sell-offs can. So there's two different things. The sell-offs can last, but the spike in the VIX eventually will be normalized, or some of that sell-off risk will be normalized. I would suspect that we probably will see that over the coming days here, where we start seeing either the backwardation of that curve getting normalized a little bit more, the spreads getting widened and closer and closer to each other, or we start seeing this kind of incremental movement to the downside when it comes to the VIX. That does not mean that it's automatically bullish for the market. Just keep that in mind here. So if you're kind of concerned about where the VIX is at right now, can it go higher? Of course, anything can happen. But you would need to continue to have these exogenous events in order to kind of build up that momentum for a continued VIX to the upside here in the near term. So that's one thing to kind of note. Two, the technical breakdown that we've seen for the S&P 500 has been significant. We have to acknowledge that, but we've been asking for it. We've been asking for this type of pullback. So if you're a longer term investor, I'm not saying intraday, I'm not even saying swing trading. I'm saying for a longer term investor, you go back, what you need to do if you're freaking out today, you go back, you look at a monthly chart, you go back max time frames, and you look at that chart and you continue to see that move to the upside here for the S&P 500. Over time, we overcome events. And this is going to be no different. So if you're DCAing or dollar cost averaging into a position, this could be one of those opportunities that you may perceive some value in certain stocks if you want to buy them at certain levels, right? I'm not saying people go out there full port, but if you're saying, hey, NVIDIA looks attractive here at $90, or if you're saying that Tesla looks attractive here or whatever, if that's the case, then for your longer term portfolio, maybe start averaging down if you have been holding off on that here in the near term. And then be careful with dead cat bounces. We're a lot closer to the 200 SMA than I think people really do realize. And a really good technical bounce would be off that 200-day SMA. So I'm not saying that we're going to get there, but if you're a technician, would you rather see an island candle, Jason, or would you rather see a candle or continued move to the downside, hit that 200-day moving average at 5,000, basically 5,100 or 5,011 on the S&P 500? Then you see the buyer stepping in. Once again, go back on your longer term time frame charts and see the reaction that you get at the 200-day moving average from a systematic and modeling standpoint that tends to kind of attract buyers to step into the market. So is this situation, is the sell-off unique? Yes. Were we in complacent markets? I mean, we had an 11 VIX 2 months ago for like a day or 2 days. Were we complacent? Yes. Now, if it's a learning opportunity for everybody, I'll kick it back over to you. Learning opportunity. When vol is low, you buy vol. When vol is high, you sell vol. When vol is low, there's complacency in the market. And if you were looking at just at the money, I'm not even talking about what you would really do is look at 30 delta out of the money puts, and you would buy those, kind of structure those out, ladder those out to be able to match the portfolio movement, right? On a cheaper basis. But even if you were looking at the money puts, at the time that we hit our peak, that all the way out to December, folks, if you were trying to model SPY position, SPY portfolio, out to December, it was only 1.5% of your total portfolio. Who would have loved to take a 1.5% haircut at that time on their portfolio to hedge downside risk? It's just something that we kind of note. Risk management is always key. But when vol is low and you can buy cheap hedges out on the curve, as much as you could possibly stomach to go out, that's usually the time that you should do it. Because once everybody's on one side of the boat, like we were, everybody was short vol, these spikes, they just occur that way. So I think this is very constructive. I'm not concerned. The valuations the multiples are starting to come in align a little bit more for now, right? You are seeing, once again, the market has been, 2 weeks ago, it was like, when are we going to get a 2% pullback? We haven't had one in a year and a half, and now we got one every other day happening in the market. This is what you really want to see happening right now. I'll kick it back over to you, though, because I could literally be on a soapbox about the scenario all morning long. What are you looking at? Mute button.
I am on mute. Sorry. Of course, I hit the mute button. But no, when we're looking at this type of scenario, I think it's something that, and I completely agree with your assessment, where it's, hey, I'd be looking for a bottom here. And that's a kind of an important thing. In 200-day moving averages, people go like, oh, they're not magic. It's like, well, it's something that's on everybody's chart. And when it's on everybody's chart, people look for those zones for value areas. And I don't care exactly, what type of strategy people run. I just say have some type of strategy, have some type of reason for buying. If you're a technician and you're completely looking at nothing but technicals, you have to absolutely have a reason and some process that you can do again and again. 200-day moving average. I had a friend who used to call it Algo City, basically saying that, and he didn't really know much about technology at all, but he would basically call it Algo City, meaning there'd be a bunch of buyers coming in at the 200-day moving average. And usually we do see that. So, a couple things to look for. Are we going to see a reversal candle? Will this hammer play out? Do we have a hammer today? Does it close in a hammer? Do we open higher tomorrow? And if we do all of those things, then we do have an opportunity to start buying the NASDAQ, the S&P 500, and so on. However, if it continues lower, let's say we get a hammer, let's say it doesn't follow through, or we just, start to move lower today for whatever reason, now we're looking at going all the way back to that 200-day moving average, starting to look there for some support. And either way, you have to look for the price to reverse a little bit before you want to buy. I think, though, it's the same as you, is where this looks interesting. And now the cash VIX being over the VIX is something to pay attention to, which could lead to a little bit more downside going forward. However, when we're looking at the market and this type of capitulation and this type of fear in the market all at once, because guess what? There was none. And when we think about it, how it's happened before, Kevin, think about 2018. 2018 is the last time I saw a scenario where the VIX hit like 50 in a couple days. And 2018, same type of thing. 2017 was it was the lowest volatility period in history. I don't even know how low the VIX got off the top of my head, but I feel like it got to a 10 at some point, possibly under that. It's lowest VIX in history if you go back and look at the VIX history. So basically, the market starts to trend up. So it was February 2018. In February 2018, the market goes parabolic, and then it breaks quickly. It bottomed pretty quickly, but it didn't mean it was the market was all clear after that. There was the market continued up, but there was struggles ahead. The breadth started weakening. A lot of the sectors started to look terrible. Everything topped out and a lot of things didn't make new highs either. So things to pay attention to here. However, breadth looking so good and small caps kind of widening out. If this is all very news driven, that's another thing to kind of pay attention to. So you just got to look at it a bunch of different ways, and most importantly, wait for some sort of confirmation going forward. And I think that's important. So go.
Can I highlight something real quick?
Yep, go ahead.
As of right now, at this point in time, utilities is the number one performing sector year to date. At this point in time, reiterate this. At this point in time, utilities are the best performing sector. If you're looking at the spiders, utilities are the best performing sector year to date. At this point in time, technology is only up 6.3% year to date. This is where we look at this and we have these conversations every week. And I think it's very important because you got the flashiness of what everybody wants to do. Everybody wanted to be a part of NVIDIA. And this is not a victory lap, right? We're here to educate. Everybody wanted to have that victory lap. The concentration of these technology stocks and communication services, it can be great for the S&P 500, and it can be very detrimental, right? You always have that. There's a two-sided coin that is there. But just note, utilities are the number one performing sector this year, which is wild. Now, will that continue? Who knows? But it's a situation where we can have a conversation about utilities a month ago or 2 months ago. I've written about it. We can have a conversation when it comes to staples. We can have this conversation about risk reward plays in certain sectors. And it could go over everybody's head because everybody's focusing on these 2 or 3 companies out there that were doing really great. But, as you rise really quickly, sometimes you can knife really quickly too. And that's just what we're seeing right now. So here's what I think is going to add a lot of value. Has utilities moved up too fast? Maybe. That might be the case. But you're looking at a low beta sector right now that actually will have, for the most part, attractive yields compared to treasuries if you X out taxability risk, right? So you have that. Consumer staples, something that's underloved right now and could experience some headwinds in some respects. But if you are getting that narrative of an economic slowdown and consumers kind of pulling back on spend, consumer staples could be another one that can benefit. Once again, you're talking about risk adjusted compared to the whole curve. We're not saying absolute terms. On absolute terms, I can tell you pretty much every single year the technology should, for the most part, in a bull market, for sure, outperform a lot of these defensive sectors. But that's just not where we're at right now. If we did see money moving out of the market as a whole, that would be your other sign. Right now, we'll get the updated data today, but it doesn't seem like that's an aggressive thing that's happening. You're kind of getting a rotation going from speculative sectors going into defensive, and then also catching a bid when it comes to treasuries right now. And you brought up treasuries, what, a week ago, 2 weeks ago, about how you're kind of getting along across the curve now. And that was definitely the right call at that point in time. Here's another area of the market that you got to be mindful of, two of them. And they're going to sound crazy to people, okay? But just hear me out. Multinational industrial companies right now could actually and probably will benefit from this move to the downside, especially when you're looking at the dollar and especially when you're looking at the yen, for two reasons. One, their prices for their products are going to be more attractive for their international buyers, right? So Caterpillar will now be able to compete with some of the other names that you have in China when it comes to their industrial products that are out there, right? If you're looking at these big machines, even if you're looking at some of the agricultural products, that's been a headwind for them. And even though you may say, oh, well, the price of the stock has been doing all right, listen to the conference calls. The conference calls have been telling you, look, we have some headwinds. And we also have headwinds when it comes to grains. We have inventory levels to the upside. When prices of grains go down, there's not a surprise here. Look at the price of grains. If you just look at the soybean and corn complex and compare that to the performance, the financial performance of a name like Caterpillar, of a name like John Deere, of a name like Union Pacific, which actually has a fair amount of exposure, even into energy plays too. I mean, on a weird correlation, but when you have these type of scenarios here, industrials actually can thrive, and it's just because of that dollar move alone. And we talk about when we're right, and we're talk about when we're wrong. Grains have surprised me to the downside. We knew that there was going to be headwinds when it comes to inventory. The fact that we had La Nina being pushed out so far, also I don't think was really priced in. Now you're getting to a situation where speculators are completely net short these positions, right? And they might be able to increase that. But dollar going down, what also is going to make it look very attractive? Export demand. And I brought that up in a small post like yesterday, and I'll probably do a full write-up of this. Keep your eye out on the weekly export demand numbers that come out from the USDA over the next 3 weeks. And if China is going to capitalize on the fact that basically our grains are basically trading at parity to Argentina, and actually we're trading for the most part now probably cheaper than Brazil. That wasn't the case 2 months ago. And if that is going to be the case right now, you're talking about higher quality product at cheaper prices. Any consumer knows, right? What are you going to do? I'm getting better value by buying from the US. That could also create a situation where those shorts on grains, corn, soybeans, to get a little bit of a short squeeze. I'm not saying that that's a longer term price action move to the upside, right? Look, our harvest should be really good. Unless we have some crazy weather event that takes place over the next month and a half, 2 months, our harvest is probably going to be over what the USDA's projections are for this year. Our ending stocks for last year already at exceptional levels to the upside. That's probably going to be the case this year. But all we're talking about from a tactical standpoint is a short-term squeeze. And if China comes in and says, okay, we're ready to buy old crop and new on the curve, that could be, grains actually could be a beneficiary of this over the next couple of weeks. And I would just be mindful of that. So grains, industrials, utilities, staples, those are those defensive plays that and then also looking at treasuries. Those are the defensive plays where they might still go down, but they probably will go down in a lesser fashion than high beta tech.
No, I agree. And that's great points there. And I want to touch on this question real fast before we get too far away from it. But any thoughts on the impact of CTA selling? So what's interesting, so a couple of different things. We could go CTAs as a whole, systematic CTAs. There's a bunch of different forms of CTAs. If you're looking at systematic CTAs, which is what they usually do to give you those lists of, hey, look how many CTAs are selling or not. One thing that's really interesting that not a lot of people talk about is that is not a very large part of futures. It's not a very large thing. They act like it's like, oh, look, they're all long. Or, look, they're all short. It's just not the biggest indicator out there. So also when you're looking at it, you could look at very simple things like basically if you're looking at a systematic trend follower, you could look at 50-day lows and 100-day lows as the most long-term time frame that you're going to see there. When you see both of those hit, you will see a lot of follow through for a second, but sometimes it leaves it to the point where there's not many people left to sell. And so sometimes you'll see those major levels that all the CTAs use all get hit kind of at the same time, and you'll see that the price will bounce at those levels, which is why a lot of older CTAs use things like weekly closes or end of day closes and so on, because you'll see a lot of bounces around those levels because once everybody's sold, who's left to really sell? And especially when you see this much fear in the market. And like Kevin said earlier, you know, we've been talking about these ideas. I've had an idea a while ago that I put out to our followers about buying calls on the VIX. We did that. It was a great hedge. Sadly, I sold. So some of them told me they didn't sell theirs. So good job from you guys. But I sold mine on Friday just before the big bounce today. So sadly, I missed out on it. But I'm glad other people caught it even better than I did. So that's great. But it's part of it is as a CTA or a trend following trader, like you're going to move into different areas. For me, you know, Kevin mentioned before, getting into things like bonds. Like you're in the trend following and you go, okay, well, bonds are starting to move. And this is kind of how I create my major macro models too, is now I'm starting to see bonds starting to catch a bid. And I can be very, like, I'm bearish as hell when my models are all bearish. And I'm bearish on bonds. And you can look at tons of things of me talking about being bearish on bonds until the point where I bought the 2-year, and then we bought the 5-year. And then last week we bought the 30-year. And it was literally, you know, right before Fed Day. When the 30-year came in and we had calls on it. So, you know, all of those trades kind of work to maneuver your portfolio into different areas. So you're not just sitting there stuck with one trade and going, oh, the S&P is going up or down and I only make money on these two things. You can be in many different areas as a CTA or a trend follower. So, you know, I think it's very important to diversify for those reasons. And also just the impact on selling. I don't think it's as significant. I think most of them would probably have their stops hit or their trend models hit sooner than later, which probably already happened. And if they didn't happen now, the 200-day moving average is coming up quickly. So who's left to really sell? Do you have anything to add on to that one, Kevin?
Yeah, no, I'm right there with you. And it also depends on the market too. So like the equity indexes, it's hard to say who's like a speculate, right? Because you have dealers there, and then you also have what we call like managed money. And so sometimes that's a little bit of a blurred line. And actually, a lot of these institutions have been selling the E-mini S&Ps all the way up. And the reason why they're doing that, or a way that they can actually scalp, is they sell the E-mini S&P futures, but they're still net long in their portfolio. And they might actually go net long and be a little bit more overexposed on the delta side to the bigger names like the NVIDIAs and what have you. What they're trying to do is basically capture that spread between the broader index itself and those top 7 or top 10 performing names. So, you know, last year we got a lot of these screenshots like, man, look at these hedge funds. They're completely off sides. It's like, no, that's not the case. They're basically just scalping. They're making money on the spread on that. And so it's kind of an opposite relationship that you kind of have when you're looking at speculative flows or managed money flows when it comes to the indexes compared to physically delivered underlines. You know, if you're talking about corn, can corn continue to go down? Yeah, of course. I think you have a major support area sitting at 313 and some change. I just had it up. So can there be another move to the upside or downside? Yeah, for sure. But what you did see last week is actually some short covering of corn contracts, around 6,000 contracts, which is not a lot. But once again, that's something that you want to be kind of mindful of. The other one that I'm actually keeping my eye out on is going to be the Canadian dollar. I mean, the Canadian dollar is probably the most extreme oversold when you're looking at net positions in a very, 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 very long time. So what's going to happen when the Fed cuts rates and the dollar goes to the downside, right? Canadian dollar should theoretically kind of push to the upside, and you have a lot of short sellers that are there. They're going to be covering their contracts. I mean, that's something to kind of keep in mind too. So I'm keeping my eye out on the Canadian dollar because that could be one that's once again extremely oversold. That could be you just see some buying activity that's taking place. So yeah, that's kind of where I'm at when it comes to CTs. I'm very selective. I mean, honestly, I follow CTA flows for metals. This is going to sound like everything, right? But for metals, energy and grains are the three ones. Everything else I really don't like. So softs, I'll keep my eye out on softs, but the markets are so thin that sometimes the positioning really gets distorted fairly quickly, and somebody can close a position before that report comes out and really kind of distorts those flows. So that's why we keep an eye out. When coffee's doing its thing, it's like, all right, be mindful of it. But at the end of the day, things can reverse fairly quickly, and that's exactly what happened to coffee, actually.
Yeah, exactly. No, I agree, and I think the thing about the Canadian dollar is really interesting. And I went and pulled up that chart. We were talking about it for a little while now, and as we keep talking about this one, the positioning keeps getting extreme and more extreme over time. And something that's important to think about is exactly what Kevin just said. Things can always keep going down. So I like to use a couple different things. If you see this type of positioning, I like to pay attention to it and go, okay, that's extreme. Bottoms usually happen around these times. However, I also want to wait for a price action signal. I would like to see it break that, base 76 level, I think it is. I can't remember. We have a buy signal set up, but, waiting for it to break those major levels, that's going to be very important. So if we can continue to kind of look at this, hopefully see this break a major level to the upside, I would absolutely want to get long it, especially looking at the scenario with the dollar right now, the dollar looking as weak as it is. That's incredibly interesting too. So something we could talk about a little bit more is just the dollar. Like you mentioned trade and the dollar. All these things kind of go together. What are you thinking? And something you talked about before, in a phrase you use a lot, which is, if the dollar isn't respecting the move on the way up, it probably won't respect it on the way down. Meaning, if you're looking at oil to the dollar, what's it doing? Oil went up with the dollar recently. Will it go down with the dollar, or will it go down with the dollar? And it has actually been going down as the dollar's been going down. So that's a good call. So what are you thinking with the dollar right now? I'll try to pull up a chart too, and then we could talk a little bit more about it, because it looks like it's starting to break out of that triangle finally.
Yeah, it's trying to move to the downside. So from a fundamental standpoint, as we cut rates here in the United States, now people are talking about a 50 basis point rate cut in September. Some other people, just because of what we've seen over the last 24 to 48 hours, are expecting maybe even an emergency cut. And I can just tell you, if you see the Fed make an emergency cut, we got problems. Like, we got big boy, big girl problems, rather than just a little bit. I mean, this is still a technical correction that everybody's been begging for a very long time. So this shouldn't freak you out. What would freak me out is if you actually did see an emergency rate cut of 25 or even 50 basis points. That would be a problem, because the only thing that has fundamentally changed since Friday, and we actually did a discussion on it, the only thing that's changed is the unemployment rate. Mm-hmm. And that one was like, the writing was kind of on the wall there. People are freaking out about the yen US dollar pair. Look, once again, that's on your radar. That should have been on your radar. Once we got to 152 on the US dollar yen pair, and when you started seeing intervention, well, what's going to happen? I mean, at the end of the day, the Bank of Japan has more ammunition than you do, than the market does. The Federal Reserve has more ammunition than any of us could ever imagine. So they're going to have to take action. And we saw that sharp move to the downside when it comes to the yen. Be mindful, though. The yen is only like 5%, like 7%. I would have to get the new weighting, the accurate weighting on there. But the majority of the dollar index is coming from the euro. And so it really depends on what the Eurozone is going to do, not really what the yen's going to do. The yen's going to have some of an impact. We talked about it last week too, 142 and some change. That would be your area of major concern, especially this rapidly to the downside when it comes to the yen. If you think about it today, what did we hit? 141.65 on the yen, and then saw buyers stepping in. That's a key area, technical area there. Once again, you're seeing the unraveling of the carry trade. I think people might be blowing it up a little bit more than what. Let me not say that. I think people that may not fully understand how the trade works may be exaggerating this trade a little bit. And here's the reason why I say this. Those carry trades are not like, those are things that are done by private equity firms, hedge funds, right? We don't have a lot of insight. And we talked about this with Shop last week. We don't have a lot of insight until actually something breaks and somebody goes under because of it. That's what we're going to get the insight on. It's not like we get a daily report and says, oh, okay, here's today's carry trade balance that was out there. It just doesn't work that way.
No COT data for carry trades.
Yeah, it doesn't work that way. So unfortunately, you're not going to get the day-by-day metrics. You're not going to hear about it until we get earnings announcements. You're not going to hear about it until somebody fails and it's a headline on the Bloomberg or a headline on Reuters. You're not going to really hear about that type of stuff. Do we know what's happening in the background? Yes. But there's a lot more than just an unwinding of the carry trade that's happening with the yen right now. The Bank of Japan is in a rock and a hard place, and they have been. They either have to stabilize the yen mechanically, either by selling off U.S. treasuries and German bonds to be able to buy yen to strengthen it. Are we seeing a huge sell-off or a flood in the market when it comes to treasuries, notes, and paper right now? No, not yet. When that happens, you'll know. We're not seeing that yet. Are you hearing the commentary shift when it comes to raising rates and maybe some of the stimulant policies from the BOJ? Yes. And that's why people are, okay, now you're taking them seriously. People were calling BS the whole way up, past 152 higher, the whole way up. The Bank of Japan was coming out and saying this, that, and the other. And the market said, yeah, right. Action is better than words. And now we actually have words that are kind of leading to the action of, okay, they're kind of taking this stuff seriously now. And now you're having another situation where the yen was one of the most heavily shorted pairs that were out there for decades. This is nothing that's new. People were shorting yen all day, every day. Now you're seeing this recovering effect happening there, and which is fine. But just understand that there's more than just the yen carry trade. And whoever tells you that they have more insights than you right now as to what's happening, boots on the ground, outside of them having insider information at a PE firm or a hedge fund, you're as clueless, and I say this in a nice way, you're as clueless as everybody else that's kind of watching this reaction, because no one has insights into how this is unraveling until we actually get some more clarity there. So that's my little spiel when it comes to the yen. And then also the fact that the yen has made such a dramatic move to the downside, and the dollar on a relative basis hasn't really reciprocated. And that's because of the weighting. It's always nice to be able to understand the products that you trade or the products that you follow. I always want to be a huge believer of that. If you want to trade an ETF, you better understand what's in the underlying of that ETF. You want to look at the dollar index, you better understand what's happening with the dollar index. Because if you wanted to short the dollar index just because of the yen, you got another thing coming to you. It's not going to give you that beta that you want to. If you're going to try to do that, you just go outright straight short dollar against the yen pair. And I would say that is very dangerous right now with the central banks going to be taking action. I started trading as a currency trader. I was a Forex trader before I traded anything else. And I can tell you, you never want to be on the wrong side of a bank, of a central bank. I don't care who it is. Care who it is. It's detrimental to an account. But that 142 touch and that bounce back off of that is something that's very telling. Now, it could continue to move to the downside there. It would break a structural wedge, expanding wedge pattern, you could say, what have you, right? So maybe we do break through it, but I would say that would be your eye. You keep your eye out on that. You break through 140, then yeah, like we'll talk about something a little bit different. But I'm not too concerned about that. I don't think people should freak out quite yet. That's basically what I'm trying to highlight here.
No, I agree, and I think that's a big thing right now. Is I think the panic isn't really needed at the moment. I think whatever way you look at it, if you're looking at, some people are looking at what the Fed's doing and they're going, okay, the Fed is terrible, it's destroying the market, and then they're going straight to the election, and they're going the election, people are thinking then this is ridiculous, they're like, okay, Democrats going to get in, it's going to destroy the whole everything. And I'm not political on this show at all. I'm just saying that these are just things that, like, you're reading into things too much if you're getting into these points. And I had a buddy who said they watched they were talking to, and this is two different buddies actually. So they're talking to other traders at firms, and they're talking about the election and so on. That does happen because guess what? Traders at firms are normal people. Normal people will talk about the election being something, and they're gonna like a candidate, they're gonna dislike a candidate. I think the biggest misconception by new traders is that people who are the top of the top, the professionals, even though sure it's hard to make it in this business, but sometimes there's people who just are they basically got some money, they start a fund and so on. Like, this doesn't make you a genius.
Yeah.
And either way, like, you can be wrong too. Like, I've been trading a long time. I have a fund. I can be wrong just like anybody else. So I'm not saying that, every idea is stupid and it has to be this or that. I'm saying I'm seeing a lot of panic in areas that people aren't really understanding completely. And when that usually happens, the market usually isn't in as much of a bad state as people believe. I believe it's summer. I believe, trading volumes are very light here. And when we're in summer and trading volumes are very light, you get into scenarios where the market makes huge moves one way or the other, sometimes to the upside, sometimes to the downside. So I feel like we're overshooting a bit, which is completely normal. I would still wait. I would still not do anything too crazy. Don't try to just get into every position unless you're doing something like Kevin said earlier. You're a long-term trader, dollar cost averaging. But I don't think this looks as bad as people think. And I do think, the yen is a huge part of this whole scenario at the moment, because if you want to look at a correlation of the market going one way or the other, or if you want to look at the stock market for the Nikkei in Japan, like look at how bad that thing's getting hit. Look at the USD yen pair compared to the S&P 500. Look at the correlation to the yen at the moment. Like, it's really high. So pay attention to that. There's going to be a lot of central bank intervention coming up soon. I would be waiting for that at the moment. And when that happens, it's going to be a very interesting trading environment going forward.
Yeah, I mean, look, I think what people are also kind of putting in and factoring in is that us hitting 5,600. I don't even know. Us hitting 5,669.67 on the S&P 500 at that time, with one of the most elevated multiples that are out there. Some people we're assuming that was still a correct price in the market, right? What if we did overshoot to the upside when it comes to equity valuations, which we probably did? And that's why I say don't freak out right now. This is a decent scenario. We get down 20%, then freak out. We get to, but don't freak out right now. I mean, I'm looking at the S&P 500. 20% correction on the NDX actually could be something that does it, because I mean that's where the bulk of the frothiness is in the market. But you're right, and I want to kind of go back and highlight this, because I've seen people actually share comp charts of the probability of Trump being in the market or winning the presidency, and overlaying that with the S&P 500 and being like, look at this correlation. Oh my God. And it's like, really? Or is it the fact that we are now at a 4.3% unemployment rate when everybody was pricing in at 4.1% unemployment rate, and now it's starting to match initial claims? Or could it be that the ISM new order data is now reflecting 2009 levels, May of 2009 levels? And if you don't have new orders, are you selling stuff? Let's be logical here. If I don't have new orders, am I selling something? No. If my new orders keep contracting, is that a bad thing for top line growth? It is. If my prices are still going up at an elevated rate, but my inventory levels are going low and my new orders are going low, is that a good scenario? No, that's stagflationary. What I'm trying to highlight here is that there's a lot that is going on that's beyond politics. We could literally be in a mid-cycle year where no one would care, and this sell-off would be justified. And that's what I'm trying to highlight here. Don't get so wrapped up in your own personal feelings about politics and have that overshadow some of the other stuff that the writing has been on the wall here. I mean, this isn't a surprise to me by any stretch of the imagination. Now, swift and quick is my new thing. If you want to pull back, you want that bad boy to be swift and quick. If you're crying right now, or you're like looking at it and saying, oh man, I got a 50 VIX. This is like, oh, the world is ending. You want that VIX to be at 65. You want us to hit that 200-day moving average. And you want a power candle like you wouldn't believe coming off of that bad boy. And that's the faster the correction, the easier the pain. The slow grinds to the downside, if you guys kind of look at it on a historic basis, right? And the slow grinds are actually the most frustrating markets, because you can't really call those bottoms. The valuations just continue just melt down, and you're having that being coupled with the earnings data and the earnings forecast kind of going to the downside. Those markets suck. Those are the ones that really weigh on people. But the quick, swift moves are the ones that are like, okay, yeah, we had a pullback, we snapped back. April, really good example of that. Right? Even October, if you look at the swift moves that we had, I mean, we were in a slow grind, and then we just had that power, like just flush out, right? Once again, you can justify that. And I think this swift move to the downside is what we want. If you're a bull in this market, you want this. If you're a bear in the market, you're going to capitalize quickly, but you better be very careful, because it doesn't take much to create. I mean, we had it on an intraday basis today. ISM services data came out very strong. The prices side of that also looked really bad. Yields went up. Equity markets went up, because that's the new correlation. Get used to that. Yields up, equities up, yields down, equities down, risk on, risk off. Also looking at that for the dollar too. That's your new, if somebody's telling you, oh man, yields going lower is going to be bullish for equities, you look at them and you be like, all right, cool. But then, keep your head to the grindstone and understand this is late cycle. We're in a late cycle. We're not in early cycle. We're late cycle right now. And late cycle means defensive stocks. Late cycle means those that are going to be piling into treasuries, because they know that there's going to be peak rates on the short end of the curve because of Fed action. That means the normalization and the uninverting of the yield curve. We already have that happening with the 10-year note futures, and the new and not the new, in the 2-year futures. We uninverted there. Look at history. Every time that we've had an uninversion, it's been painful in equities. We don't know how long that duration is going to be, but it's just how it is, and it's just taking a lot longer. So everybody just relax. We're gonna be good. We're gonna be good. Commodities might be in a bad spot. Like let's call a spade here. If we're going to continue to have this trajectory of economic data points, at least for the U.S., it doesn't look great. Now, I think we have to have a little bit of a conversation around, and we maybe we can have it now. No, I'm saying not now. I'm saying theoretically, right? Hypothetically, there's a difference between a U.S. slowdown and a global economic slowdown. We have to be mindful of that. There's a difference between the two. Just because we have a slowdown does not mean the overall global economy has to have one. And honestly, the Eurozone has been in one. China has been in one. I mean, they're farther ahead of this curve than we are right now when it comes to economic cycles. So that can also put a play in there as well. But if we continue to have this weak data, commodities pretty much across the board, it's going to be very hard to justify. It's going to be hard to justify. Copper hit $4. Seeing a nice little pop right now. Copper hit $4 yesterday. I mean, that's kind of your line in the sand, right? You're looking at silver, still looking weak, and that has the precious metal complex to it. But the production side, or the global expansion of the industrial side, continues to look weak. So you're seeing that kind of pull back here. This might not be the great scenario for commodities across the board, which is fine for now, right? And then once the commodities bottom, hear me out. You're going to hear it here first. Commodities will bottom before anything else does. Commodities will bottom before the economy bottoms. When the commodities bottom, that's your signal. That's your signal that we're close. Okay. That's what we have to be mindful of. Just because you follow the trends like you do, but commodities will give you that sign. Once they do, then we're back on. We're just not there yet. We'll be there for another couple months. Sorry.
What you just said is incredibly important, and we also need to talk about that a bit more. So if we go back to 2000, for example, like we see, China wrapping up in 2000. We see our market, though, we had the NASDAQ bubble. So the tech bubble happens. We have the bubble pop. The thing that people don't go back to, and it's the reason why, you wake up and, if you literally just follow, 20 people on Twitter who talk about equities every day, you're going to have the same conversation over again, the same feelings every single day. You get on there and you see, I saw like 20 people saying like, you know, overnight market, this is Apple is down this much, Tesla down this much. And like, it's a huge market out there. You know, bonds are up a lot. Like certain things are actually did move the other direction last night. But if you go back to 2000 and you see that bubble burst, it's the same thing. Nobody even looks back and looks at like anything else inside of there or other sectors inside the stock market. But if you looked at microcaps then won the war at that point. Like microcaps started to move, energy started to move. They bottomed out way before equities, years before equities actually. Gold miners were the place you wanted to be. So basically what I'm saying is it's a good time to take this to heart. And it's a thing that I say all the time is that you want to pay attention to commodities because the cycles are big and they happen and they're going to happen again. And I completely agree with Kevin. It's a scenario you and I have actually been putting out for a while. This is either going to go one of two ways. One way, the Fed starts to actually cut a credit like at the beginning of the year. Let's say that it's neither you nor I thought they were going to cut that early anyways. But I'm saying, let's say it magically happened and they start to cut aggressively. Liquidity starts flowing in the market. Then commodities I thought would probably catch a bid. But the other scenario that we talked about a bunch was commodities might start to take a hit and we might see a little bit of a disinflationary, deflationary shock kind of happen. So we see that shock happening possibly right now. Bonds are
already happening.
Yep, it's here. Maybe that's the end of it here. I don't know.
Yeah,
you know
that's the thing. I mean, oil's been sliding already. I mean, we had that bounce. Oil's been sliding. Copper's been sliding.
Yep.
They told us beforehand.
Yep.
They told us beforehand what was happening, right?
Yep. So we saw those shocks kind of happen already. So it's kind of a like, hey, you know, this could be a very interesting time to start paying attention to commodities. I'm not saying I would buy. Most of them are moving into downtrends right now. Most of them are moving sideways. Yes, gold, silver, like still you want to be in understand these things because one, you could short just as easily as you can go long. So you of course you want to be understand futures because of that, but also look at gold, look at silver. You know, these things are holding up really well, especially gold even much better than silver. The bond market, you know, you could be long the euro dollar futures, if they call them SOFR right now, but I'm still not switched over to that yet because I'm old. So the SOFR rate futures, the 2-year futures, the 5-year futures, you can't really trade these things in equities. Like if you use the ETFs, you're not going to get any alpha. If you use the options in those very short dated bond ETFs, there's very low liquidity. So you just don't want to trade any of those. So what I'm saying is try to understand the futures market now where we're kind of a little bit ahead of the curve of what Kevin is saying at the moment. Now would be the time to kind of get involved, understand it, and really be interested in this market that is the market that runs the world.
Yeah. Nice little power move for equities right now.
Yeah, I'm pretty excited about it. I am seeing like a lot of this, you know, it's a thing we talked about earlier. It's like panic, and a quick panic is great.
Yeah.
It's almost the same thing, you know, like it could have happened, sure, and this is the hard part about it, and this is why you don't try to buy bottoms. Friday, for example, you could have said something similar. Hey, we're at wow, VIX hit 30 from nothing, basically. That's a pretty large move from nothing. So therefore, you know, we could possibly buy here. So you could possibly say that, but today, this is much crazier. I would think this is if this isn't capitulation, it is very close to it. But once again, all the things that we were talking about before, waiting for this to really bottom out, seeing this really to start to drive higher, seeing us hit the 200-day moving average, something to give some sort of confirmation. These are things I would continue to watch for. But for now, it's looking quite interesting. Natural gas is almost back to positive too.
Yeah, we're probably also seeing a little bit of a short covering event too, right? Mm-hmm. So, I mean, once again, yes, you kind of level it out. For those that are viewing, one thing that I like to do, and this is an easy trick, to see what the implied move is for the equity market, you can take the VIX and you just divide it by 16. I think that the actual calculations like the VIX divided by 2 to the square root of 5 plus something weird, right? But on average, it comes out to around 16. So A 65 VIX implied around a 4.06% daily move to the upside or downside for the S&P 500. Just for example, now the VIX is sitting at 31, divide that by 16, pricing in about a 1.9% daily move in the S&P 500. So put that in your toolkit. It's really helpful when you're kind of trying to figure out, okay, what's vol telling me? Is vol expensive? Is vol cheap? Do I want to buy options here? Do I want to sell options here? And it doesn't matter if you're looking at equities. You know, you could say the same thing when it comes to commodities as well. The CME has something called CVol, which is their kind of volatility index on pretty much almost every product that trades on the CBOE. That's also a very interesting one to kind of keep your eye out on. So, you know, once again, you're going to get a lot of volatile action in the market. As you kind of talked about, though, you know, let me go back to this thing real quick. Is the Fed, everybody's blaming the Fed right now. Were we blaming the Fed when the market priced in way too many rate cuts and got ahead of the Fed in October? No. Were we blaming the Fed when the market got too ahead of itself in April of this year? No. What happens? We tend to overreact. And now the Fed, because of the overreaction that we've seen in the market, well, I'm not blaming anybody, but this is what has happened. Now they have to come out and they say, hey, fool me once, shame on you. Fool me twice, shame on me, right? And so that's kind of the situation that's kind of happening right now. And so, you know, once again, do we see emergency rate cuts? I don't think so. And if we do, I think that would be the wrong signal to the market. We would be the only central bank out there that has gone through a hasty cut throughout this whole cycle. And we've been the strongest economy out of all of them, right? And so I think the signaling of that in itself would not be great. What the Fed could also do is also bid up treasuries, because they do have a little bit more ammunition when it comes to the roll-off of their balance sheet, and they can kind of they can get back into those a little bit more aggressively right now, and that'll continue to occur throughout the remainder of the year. So that's a shadow policy that they could implement that outside of those that actually just watch treasury auctions and watch these flows probably would go none the wiser. So that's another area where they can actually flex some power in the background. And they can also flex power in the currency markets too if they wanted to do so. They don't have to. They don't have to. So we're good. We're good. Grains, like I said, if you're going to have a bright spot, I'm looking at export data. Let's see if China's going to pick this up. And that's where I'm looking at. I mean, who would have thought that we'd be priced in lower than our South American competitors out there that's been eating our lunch when it comes to the grain market and physical demand that's out there, right?
No, seriously, for years, and it's there are things to do here, and I think that's a thing that's important to kind of end this conversation on. There's a lot of things to do here. One is put together a plan. Like I hear too many people like, you know, I'm buying a dip. That's not a plan. Like, put together a plan. When do you buy the dip? When do you do certain things as a trader? Like, that's the plan as a trader. Like, you can say, like, my plan is major capitulation moments I buy. Like, I don't care what your plan is. Just have a plan, not just I buy dips when they happen. The market's down right now 7% from its highs. You know, just almost 8% from its high that hit earlier this month or last month. Sorry. So, I mean, the markets hasn't made some major move where everybody has to panic. Hell, you know, my longest term portfolios aren't really doing anything because they're not getting stopped and the trends haven't changed yet or anything. So, you know, there's a lot of things to do here. One is put together your plan. Two is learn how to trade futures so you're more ready for the next commodity cycle, and keep tuning into us so you can learn more, and we'll be here to try to guide you guys through it. So, all right, guys. Well, thanks for coming on, and thanks, Kevin. Make sure you guys follow Kevin, and we'll see you next week at 11 a.m. Make sure if you guys stuck with us, turn on the notifications on YouTube. I know everybody's usually on Twitter, but we'd advise you to get onto YouTube. It's a little bit better platform. Also, the podcast format goes onto there automatically too. So try to get onto YouTube and turn on your notifications, and you'll see us when we come on Mondays around 11.